Hey there, future investors. Welcome back to a Tomahawk Investor channel, where we dive into everything about finance, investments, and achieving your financial dream. I'm Chief Trading Bull, and today we're talking about something that can literally change your life, the real value of proper money investing. If you've ever wondered how to secure your financial future, this video is for you. Have you ever had $100 in your pocket and wondered how you could turn it into larger amounts like 100,000 or 200,000 US dollars? This skill isn't something they teach in school. So you have to grab pieces of this knowledge here and there, find free valuable content that seem rather reasonable to comprehend and simple to learn, like watching valuable videos here on my channel, for instance. Because of this lack of knowledge, it seems pretty scary for most beginners to get started in investing. I will try to broaden your perspective with my videos and will try to motivate you by showing you simplify the whole process. You see, investing isn't just for the wealthy or the financial gurus. It's for anyone who wants to build a solid financial foundation and achieve their long-term goals. Whether you're saving for retirement, a dream home, your child's education, or even that world tour you've always wanted, smart investing can help you get there. But here's the kicker: the earlier you start, the better. Thanks to the magic of compound interest, even small regular investments can grow substantially over 30 years. Imagine this: investing just $200 a month can potentially turn into a six-figure sum by the time you're ready to retire. It's all about consistency and making your money work for you. Many will say it is impossible to become rich by investing small amounts, or may say, "My spouse is taking care of my finances. I don't have to think about this now. I'm too busy enjoying life." "Oh, it's too difficult to learn different investment instruments. I don't care if I want to become rich." People should decide on their own whether they will spend the entire day watching television, sleeping, or playing online games, or you should invest in your financial education and sharpen your brain. The freedom of choice is sometimes so powerful, yet so much difficult for some people. So, if you are ready to take control of your financial future, stick around. We're going to dive deeper into how you can start investing today, no matter your budget, and set yourself on a path to financial freedom. To follow us, make sure to hit that subscribe button, give us a thumbs up, and ring that notification so you don't miss any of our tips and strategies. Let's get started on your journey to smart investing. Now, first thing I should advise any new aspiring investor is to invest in her education. In reality, the only real asset you have in the beginning is your tomahawk brain. The power of you and your brain can move mountains. So it is a smart investment if you use your first $200 to buy online investment courses or some books that talk about investing in stocks, bonds, real estate, and other valuables. However, let's talk about the specific places you can actually put your investment money. Over the next 15 minutes, we'll dive into the investment landscape of the past 30 years in the United States of America. We'll explore 5 different randomly selected investment opportunities: gold, the S&P 500 index fund, McDonald stock, 30 years US Treasury Bonds, and US dollar 12-month cash deposits. And we'll see how a simple strategy of investing $100 monthly over 30 years would have performed in each of these instruments. Number 1. Gold. First up, let's talk about gold. Often seen as a safe haven during economic uncertainty, gold has had a fascinating journey. Over the last 30 years, gold prices have seen significant volatility, especially during the financial crisis of 2008. and more recently during the COVID-19 pandemic. Gold is often seen as a hedge against inflation. When the value of currency decreases, the price of gold typically rises, preserving wealth. Imagine you're on a sinking ship made of paper money. As the waves of inflation crash around you, everyone's scrambling for the one thing that floats: gold. Turns out, gold is the ultimate inflatable lifeboat. Gold has been the king of bling for thousands of years. From ancient pharaohs to modern investors, everyone loves a bit of shiny. It's like the world's oldest fashion trend that never goes out of style. Once upon a time, pirates roamed the seas, burying chests of gold. Fast forward to today, and we're still chasing the treasure. Gold doesn't rust or fade, making it the timeless champion of finders keepers. To summarize, if you had invested $100 each month in gold for the last 30 years, your total investment of $36,000 would have grown to approximately $150,000 today. That translates to an annualized return of around 8%. Number 2. S&P 500 Index Fund. Next, let's explore the S&P 500 Index Fund. Investing in an S&P 500 Index Fund gives you exposure to 500 of the largest companies in the United States. This means instant diversification across various sectors, reducing risk compared to investing in an individual stocks. The S&P 500 is often considered the benchmark for the US stock market. Investing in an S&P 500 index fund means you're essentially betting on the overall health and growth of the American economy. Historically, the S&P 500 has provided solid returns over the long term. While there are ups and downs, the long-term trend has been upward. With dividends reinvested, the average annual total return was around 11.6%. The index had positive returns in 36 out of 50 years, with best year in 1995 with return of 37.6%. The worst year was 2008 with a 37% loss, but overall, index had always recovered and has shown a robust upward trend. This index is a popular choice for diversified investment. Imagine walking into an all-you-can-eat buffet, but instead of food, it's filled with stocks. The S&P 500 Index Fund is like loading up your plate with a bit of everything: tech, healthcare, finance, so you never miss out on any of the market's tasty offerings. To summarize, investing $100 each month in the S&P 500 Index Fund over the past 30 years would have grown your $36,000 investment to around $353,000. This represents an impressive annualized return of 12% with regular reinvesting of dividends. Number 3. McDonald stock. Now, let's take a look at a single equity investment, McDonald's share. One of the most recognizable brands. As a blue-chip stock, McDonald's has provided steady growth and paid regular 2 to 3% average annual dividends to its investors over many years. McDonald's is a member of the S&P 500 Dividend Aristocrats Index, meaning it has consistently increased its dividend payout for at least 25 consecutive years. This makes it an attractive option for income-focused investors. McDonald's has a resilient business model with a mix of company-owned and franchise restaurants. The franchising model generates stable, high-margin revenue through franchise fees and rent, reducing overall risk. McDonald's also is one of the largest real estate owners in the world. The company owns the land and buildings at many of its locations, providing significant value and stability beyond just its operational revenue. Imagine having a passport that works in over 100 countries. That's McDonald's for you. Whether you're in Paris, Tokyo, or Timbuktu, those golden arches are a universal sign that you're never far away from a familiar burger and fries. Picture McDonald's as a royal king sitting on a throne made of Big Macs and handing out golden nuggets, dividends to loyal subjects, investors. For over 25 years, this monarch has been sharing the wealth, making it a regal choice for income seekers. To summarize, investing $100 monthly in McDonald's stock for the last 30 years would have turned your $36,000 into approximately $624,000. Thanks to a combination of capital appreciation of 12% and dividends between 2.5% and 3%. That is annualized return of around 14.5%. Having on mind McDonald's is not a risky stock. With more riskier, you can achieve higher percentages. Number 4. 30-year US Treasury Bonds. Let's shift our focus to a more conservative investment, 30-year US Treasury Bonds. These bonds are backed by the full faith and credit of the US government, making them one of the safest investments available. These bonds offer a fixed interest rate, providing predictable income over 30 years. That is especially appealing for retirees seeking a steady income stream without having a burden of stock volatility. Imagine having an ATM that never runs out of cash and is open 24/7. That's the liquidity of 30-year Treasury bonds. Whenever you need to sell, there's always someone ready to buy. However, their returns are typically lower compared with stocks' returns. To summarize, had you invested $100 each month in 30-year Treasury bonds, your $36,000 would have grown to around $76,000, reflecting an annualized return of about 4.5%. Number 5. US dollar 12-month cash deposits. Finally, let's consider US dollar 12-month cash deposits, although this is valid for most all other major currencies. These are essentially savings accounts or certificates of deposit with a fixed interest rate, offering stability but usually lower returns compared to other investment types. These one-year deposits are very liquid assets since every 12 months they mature and offer us the security and predictability knowing when the money plus interest will be returned to us to reconsider what we will do with them through the next 12-month cycle. That is why plenty of not so well-educated investors prefer them over other more riskier asset classes. This reliability of this instrument comes with low risk but also low reward. To summarize, investing $100 each month in 12 months cash deposits over a 30 years period would have increased your $36,000 to about $50,000, with an average annualized return of roughly 2%. Such yield is not much, but is safe, stable, and liquid. So we have looked through these randomly selected 5 instruments. In summary, our journey through the investment landscape of the past 30 years reveals diverse opportunities and outcomes, while conservative investments like treasury bonds and cash deposits offer safety, their returns are modest. In contrast, equity investments such as the S&P 500 index fund and McDonald's stock have provided substantial growth, albeit with higher volatility. Remember, each investment type has its own risk and reward profile. Diversification and a consistent investment strategy can help navigate market fluctuations and achieve long-term financial goals. Sometimes, even if you don't invest in your financial education, you can be lucky and some unintentional investments can turn very lucrative. Once upon a time, a group of grandmas formed an investment club, deciding to invest in what they knew best, knitting. They put money into a little-known company that made knitting supplies. That company? Berkshire Hathaway. Their small, casual investment turned into millions over the years. Now that's what I call stitching up some serious wealth. However, these accidental cases are very rare. Most of the time, those that invest their time into proper learning reach fortunes. And one other perspective. If you don't learn, you may lose substantial money or miss opportunities. Ronald Wayne, one of the co-founders of Apple, back in 1976 sold his 10% stake in Apple 10 days after Apple's foundation for a whopping $800. He thought he was making a smart move to avoid risk. Fast forward to today, and that stake would be worth over $200 billion. Talk about an unintentional goldmine he missed out on. But hey, he did make a quick buck back then. At the end, I would like to draw your attention to one important factor, which is time. It's important to note that it is difficult to reach your first 100,000 US dollars. However, after reaching your first 100K milestone, your investment explodes, and reaching your second and third 100,000 US dollar mark is much faster and easier. Why 100,000 US dollars is such a big deal? Alright, so you might be wondering, why is reaching 100,000 US dollars such a big deal? It's all about the power of compound interest. As your investment grows, the interest you earn also grows, leading to increasingly larger returns over time. It's like a snowball effect. Scenario 1. 8% annual return. Let's look at an 8% annual return example. Imagine you invest in $100 every month. To reach your first $100,000, it will take you about 25.5 years. But here's where it gets interesting. To reach the next 100,000 US dollar, it only takes around 6 to 7 years. And to get from 200,000 to 300,000, just another 4 or 5 years. The growth really starts to accelerate. Scenario 2. 10% annual return. Now, let's see what happens with 10% annual return. With the same $100 monthly investment, you'll hit 100,000 in about 22 years. Reaching 200,000 will then take around 6.4 years, and getting to 300,000 US dollars will only take an additional 3 to 4 years. See how it's speeding up. Scenario 3. 12% annual return. Finally, let's see what happens with a 12% annual return. You'll reach your first 100,000 in just 16 years. Then it takes only about 7 years to reach 200,000, and from there, just another 5 years to hit 300,000 US dollars. That's the power of higher returns. So what's the takeaway here? The time needed to accumulate each additional 100,000 decreases as your investment grows, thanks to compound interest. The earlier you start investing, the more you can benefit from this exponential growth. If you started investing $100 per month in McDonald's shares in June 1994, with an initial share price of $8 and a current share price of $259 today in 2024, it would have taken you little over 11 years to reach first 100K milestone with only 13,200 US dollars invested. After that, it takes only 7 extra years up to the year 18 to reach second 200K we added only $8,400 investment. And after that, it takes only 3 additional years to reach $300K US. By reaching amount of near $650,000 US by the year 30. So that's all folks for today. Thanks for watching. If you found this video helpful, make sure to hit that like button and subscribe for more financial tips. Let us know in the comments if you have any questions or topics you'd like us to cover next. Happy investing! Subscribe and follow us to track future videos.